All right, well, I can probably just kick it off. I don't really have too much in terms of slides and pull it up in a second. So I'm going to do just a quick introduction on myself, a little bit about what I'm working on, and call it a day. So my name is Michael. I'm the founder of a company called ChainedMetrics, where we create prediction markets on public company KPIs. So think somebody being able to essentially bet on, is Netflix new subscriber growth going to increase for Q1 2023 above market expectations? And a lot of investors just like buy a security that's tied to that, opposed to betting on the stock price going up. Or any number of other KPIs that each public company has. The most fundamental investors are looking at to value the equity. And so the reason why I started this, I was at a big hedge fund called Citadel for the last 7 years. I was the youngest managing director that ran all the software and technology for anything to do with trading equities. And so in a big hedge fund, you have different types of strategies. That's why it's called a multi-strategy fund. And the strategy I would work with is something called fundamental equities, where you have human beings reading the K's and Q's, doing fundamental modeling, trying to understand how a company is going to perform in the future, and then constructing a portfolio that reflects companies they think are going to outperform and companies are going to underperform. And you then use what's called a risk model to be able to construct a portfolio that gives you the risk exposures that you want. So let's talk about what risk means when you are investing in the stock market. So if you buy Netflix, Netflix can be completely neutral. They don't overperform, underperform, but because the market's going up, that you're going to get a positive return. Or if, let's say, just the tech sector is going to be hot, so Netflix is going to get exposure to this factor that's going to ride the wave of tech. Or if there is like some sort of like global macro event, like Russia invades Ukraine, inflation increases, interest rate increases, all of these other factors that are going to influence the performance of Netflix, the stock, it has nothing to do with the actual fundamentals of the company. But if you're buying Netflix because you think their fundamentals are going to outperform, you don't necessarily want to bet on everything that I was just talking about. So smart investors are going to look at risk of public equities and make decisions on what type of risks they want to take and what type of risks they don't. And so when somebody says the word, I have a market neutral portfolio, that means I'm trying to neutralize my exposure to the market. The market goes up, the market goes down. I have the same number of long volatility as I do short volatility. You also may say I want to have a neutral to the tech sector. So that means you might have like a long Netflix, you might short like a QQQ, which would be an ETF to short your exposure to Netflix. All of these things to ultimately say that, hey, all I'm trying to do is just bet on Netflix outperforming the market and nothing else. And so when Netflix reports their total new subscribers for maybe a Q1 print next year, as long as their subscriber growth outperforms market expectations, you're going to get positive returns. You don't care about the rest of the world. Now, everything I just said is hard. One, to forecast a company, and then create a portfolio that's going to isolate your risk to the exposure that you want. And I think I can short circuit that by just creating a financial instrument that is tied to Netflix new subscriber growth and allow any investor to be able to come in and go long or short just this KPI, opposed to going long and short the equity and worry about all the other factors. So that's what I'd love to build. The goal is to be able to simplify trading so that if you're an analyst, let's say a lot of people in here are really good at forecasting and really good data scientists, you might be able to take a data set and forecast out what is Netflix new subscriber growth going to be, or forecast out what is the pharmaceutical sales of a new drug line within Pfizer, or forecast iPhone sales, forecast out number of Tesla Model X sales. Like, that's a hard problem to do, but it's totally different if you're, just because you have a good forecast, how do you create a portfolio around it? How do you figure out what your catalyst is? How do you size it? How do you manage risk? So if we can decouple analytics and forecasting from portfolio construction, positioning, and sizing, you can start a new type of investor to start being involved in forecasting out these KPIs and monetizing it without having to have like a big hedge fund or a asset manager that does the monetization. So the hope would be more people can get involved in financial markets and using their forecasting and trade directly without having to go to the equity. And for some people, this could actually be really helpful for risk management. You don't have to, again, construct portfolios, decompose your risk, and think about your volatility exposure, these very heady concepts. You're just betting on like the one element of a company that you think is going to outperform or underperform market expectations, and don't worry about the risks of the broader market. And there is an element of capital efficiency, where right now you have to deploy a lot of capital to be able to hedge out your risk. And that is oftentimes used with margins, so like that can be relatively capital efficient. But if you don't have to deploy all this additional capital to hedge out your risk, it can potentially be more capital efficient. So that's a little bit about me, a little bit about what I'm working on. I can go at lengths on the legal side of this, because that's ultimately what any type of financial innovation becomes, is a legal and regulatory project. And so that's what we spend most of our time on. There are new laws within the SEC that are enabling innovation, I think, within the prediction market space for securities. And so we're looking at potentially leveraging something called a swap execution facility. Anybody here that's familiar with interest rate swaps or credit default swaps trade something called a SEF, but that facility's never existed for something called a security-based swap, which is what this product would technically be classified as. And so we're working on trying to be one of the first companies to have that. And yeah, and that's about all I got. Happy to take questions.
When somebody bets on a KPI, do they need someone else to take the other side of that?
Exactly. So it's similar to something like call sheet, where every instrument that is issued is fully collateralized. So it's priced anywhere between $0 and $1. And what we'll do is create a range. Let's say for earnings per share for Apple, we know it's going to be between $1 and $2 for the upcoming quarter. And the price of 20 cents for going long is going to be correspond to the 20th percentile. So basically saying it's going to be worth $1.20. And then somebody else is going to take the other side, so it's going to be less than $1.20. And so when Apple reports, let's say $1.80 EPS, 80 cents of that collateral goes to the long, 20 cents goes to the short. So there is always a counterparty. The first problem, once you solve the regulatory issues, is finding the market makers. And a good example for a market maker for this is somebody that's willing to take a spread between, I'm confident it's going to be above $1.30. I'm confident it's going to get to above $1.30 and below $1.40. So they're willing to sell that long position on Apple's EPS for anything that is more than 40 cents, and they're willing to sell a short for anything that is more than 30. And as long as it falls within that range, everything that they would be selling from the market making side would be profitable. So you start with people that are willing to find a spread over and under, and then you can start giving away that data for people that are interested in what is actually the smart consensus for this KPI going to be. So if you're an investor and you're saying, I'm trying to compare my estimate for Apple EPS to what the market is saying, you can currently use consensus and take like an average of sell side estimates that they don't necessarily have skin in the game. Or you can start looking at this market, where even though there's not a ton of liquidity, at least there's $50,000, let's say, in a market maker putting up an estimate. That is really the first time you're ever using an estimate that has actual capital behind it. The thought then being that if you have a differentiated view on Apple EPS from what this market's saying, you make a discrete decision. Do you monetize your alpha and the equity, or do you monetize it just by trading it on this platform? The advantage of this platform is you're no longer concerned about general market volatility outside of is Apple going to perform for the upcoming quarter in their EPS estimate.